So in this video, we're going to be answering the question of whether small cap stocks or large cap stocks make better long-term investments. And the reason I'm making this video is because it's something that I was personally very interested in seeing because I myself have been more focused on investing in smaller companies. So companies with market caps in the 2 billion, 1 billion, $500 million range. And the reason for that is because my assumption was you're more likely to find better investment opportunities in smaller companies because these companies are less followed by analysts. Investment funds maybe not paying attention to them because they don't meet some certain arbitrary criteria that they have to have for all their investments. And maybe even retail investors aren't interested in these companies, so they're not looking at them. Various reasons like that. Whereas large cap stocks are more well understood because everyone knows these companies, they understand the risks and rewards of investing in them very well, and it's unlikely that they're going to be misunderstood or mispriced in some way. And you kind of need a company to be a little misunderstood for it to be a great investment. You need people to think that if the company isn't as great as it actually is, or that a company is destined for failure when in reality they could recover in 2 to 3 years and those fears are overblown. So, to answer this question with some cold, hard data, I decided to go back in time 10 years and look at how companies of different sizes have performed historically. So let me show you that data right now. Now, to answer this question using a data-driven approach, I ran a backtest that generated a list of every US and Canadian listed stock as of 10 years ago, and then I ordered them by market cap from largest to smallest. And by the way, this test does account for delisted stocks as well. And then I also included, we can see this column here, what their 10-year annualized returns were. So this is the returns that you would have earned had you held this stock for 10 years, and it does account for dividends and dividend reinvesting. So this is a lot of companies. This is a big list here. Now, if you'd like to access this list for yourself to, look at the data and do your own analysis of it, you can do so by coming to my website. It's called tickernomics.com. I'll leave a link in the description of this video. It's currently a free to use website. So you just go to Tickernomics, and then in the sidebar here, you can click public scripts, and then you just search for a script called 10-year return data. So you can search it here and then it'll pop up, and then down here you can click run and it will generate this table for you that I'm showing you here that includes all this data. And if you would like to look at it in Excel too, there's a button down here that allows you to export into Excel. Now, the way I'm defining large cap stocks for this test is any company that had a market cap of at least $50 billion as of 10 years ago. So this would be early July of 2013. And for small cap stocks, I'm looking at companies that are between 500 million and $2 billion in market cap. Now, I know those don't meet the exact definitions of what you consider large cap and small cap, but that's just what I'm going to use for this test. But overall, here are the results of this back test. So I downloaded the data into Excel, and then I just did a quick summary to tell you the key insights from this. So for large cap stocks, which remember were companies with a market cap of 50 billion and up, they had an average return over the past 10 years of 10.76%. And if we look at what their market cap weighted return was, which basically assumes that we just had bought a portfolio of these companies, these 50 billion plus dollar companies, then our return was just under 12%. And this is per year, every year for 10 years. So that's pretty good overall. Now, some interesting facts about this is Apple, which even 10 years ago, Apple was still the largest company in the world or on the US stock market. They actually had the best returns. So the largest company in that cohort of 50 billion plus companies had the best returns, July 2013 until today. I thought that was pretty interesting. And what was also interesting was there were 76 total companies that met that criteria, the $50 billion criteria, and only 5 of those companies actually lost value over the last 10 years. All 71 other companies at least made you a little bit of money, whether it's through capital gains or just paying you dividends. And this is what the distribution of returns looks like. So in this axis here, we have the actual annualized returns. And then this is basically each dot represents a different company. So we can see there's a few outliers, some companies that did not do very good, these 3 companies here, but pretty much all the companies had pretty decent returns. And we can see the 10% return line here. There was about majority of the companies were above 10% annualized return. So that's pretty strong overall. Now, if we move to the small cap stocks, their returns were worse. Their average return was 7.77%, and then their market cap weighted return was 7.81%. So I thought this was pretty interesting because this is kind of counterintuitive to what I said at the beginning of this video, right? Why I'm personally more interested in smaller companies is because they're more likely to do well because they're more likely to be mispriced. But what the data here shows is that, at least in the last 10 years, large cap stocks have done significantly better. You may think, well, it's only, 3, 5% better, but 3 to 5% every year for 10 years is a big difference. And then if we look at the distribution of returns, it looks pretty much the same as what we're looking up here, except I think there were a bit more companies that were kind of below 10%, and there were a lot of companies that you would have lost money on, which makes sense, right? These are smaller companies. These are, a $500 million company is pretty unproven at that point. Maybe they don't have profitable operations yet. So there's a lot more risk, but there were certain companies that actually did quite well. But what I thought was interesting was, if you're looking, for really strong returns from companies, right? So say 30 plus percent every year for 10 years. Really, I mean, there was obviously more in this because it's just a larger sample size. There's more, companies in the 500 to $2 billion range. But there were companies in the large cap area that you would have achieved those, stellar 30 plus percent per year returns with, namely Apple, which had something like 35% annualized returns. So this kind of shows that, just because a company is big, at least what's been proven in the last 10 years, it's just because a company is big doesn't mean it can't have great returns going forward. Now, one reason for this outperformance that we've observed in large cap stocks is due to the rise of index fund investing, which, as you probably know, is a passive investing strategy that has caused more and more funds to be allocated disproportionately to large cap stocks, regardless of any actual changes in the fundamentals of those businesses, and just because they're included as part of some index. Because in index fund investing, you simply invest in all companies at market cap weights. So large cap stocks receive a larger share of the funds that get allocated towards index funds. Because of that, they have more buying coming in for them, which causes their prices to go up. Even if the actual fundamentals of those businesses haven't changed, just their inclusion and their share of being part of an index can cause this increase in buying. Now, to put this all into context, in the year 1980, there was about $10 billion worth of assets invested in passive index funds, and 90% of that was tied to the S&P 500. By 1990, that number had increased to 170 billion. By the year 2000, that number was 1.4 trillion, and by 2010, it was 2 trillion, and then by 2020, it was $11 trillion. And additionally, about 21.2% of all the S&P 500 companies' shares are now held inside passive index funds compared to 20 years ago, where it was only 3.3%. So this is obviously a very substantial change. In Seth Klarman's classic investing book called Margin of Safety, which was published back in 1991, he points out this exact trend, and he says that the success of passive index investing will entice more people to do it, thus bolstering the performance of that index, leading to, in turn, more indexing, as investors have traditionally made their investing decisions based off of historical returns, which you can argue that you shouldn't do that because there's that old saying, don't make future financial decisions based off of historical performance. But in reality, that is what investors do. And what was also interesting is he predicted in that book that this trend of index fund investing will turn out to just be another Wall Street fad and it will soon die out, which is obviously not what ended up happening. Over the years, more and more investors just lost confidence in people's ability to outperform the market. They didn't want to pay high fees for active management anymore, and they decided instead to just match the index, and that was good enough for them. And really, the rise of passive index fund investing is arguably the most important development we've seen in the investing space over the past few decades. But it has happened not without its fair share of some very real concerns that have been raised, one of which is called the problem of 12, which was talked about in a paper from Harvard professor John Coates. And it states that the control of most public companies will soon be concentrated in the hands of 12 or fewer people if this trend of passive index investing does continue. So it's interesting to know that what's now considered really the most basic level of personal finance knowledge, right? Just invest in low-cost ETFs that track the market, hold them for 30 years, and you'll be rich in the future. really, I mean, 30 years ago, that wasn't conventional wisdom, and it now is. So it is interesting to see how fast things can change and if this will continue to be the conventional wisdom going forward. So, overall, I think it's fair to say that there's no definitive answer as to whether companies of a specific size are going to be perennially better investments, because depending on the time period, you're going to get different results because you have to account for all the other developments that are happening in the financial markets to really understand what will do better. Because, as we saw from the data, at least in the last 10 years, large cap stocks did much better than smaller stocks. But that may not be true over the next decade because a big reason for that was this massive rise in index fund investing, which may not be as substantial over the next decade if it doesn't gain as much popularity. So, my advice to you would be just focus, if you're going to go the route of investing in individual companies, just invest in companies that you actually understand. Don't have these arbitrary requirements of what size a company needs to be because you have some belief that companies that are of that size are going to be better investments. What we saw from the data is that it really doesn't matter, and there can be great investments picked from all different size categories for companies. So anyways, guys, that pretty much does it for this video. I hope you did find value in this video. If you do like this style of content, I'd recommend checking out a similar video I made where I was comparing high quality stocks to well-priced stocks, which I will leave on screen now.